The future of DSCR loans. Hey, what's going on, everybody? It's Jeff, the Mortgage Bro. Hope you're doing really well today. Thanks so much for watching my channel. I really appreciate it. I've been doing some thinking a little bit, and I thought, hey, what are people thinking about? What's going to happen in the future with DSCR loans? So I thought, let me come up with some ideas to chat with you guys about today about what the future of DSCR loans look like. Before I get into it, do me a huge favor. If you like my videos, especially about DSCR loans, go ahead and click the like button, and then go ahead and subscribe to my channel because I talk about these things a lot, obviously, going forward. I'd love to have you as part of the community of people that I'm interacting with online and maybe even in person sometime. Okay, so let's talk about the future of DSCR loans. So number one, I think at some point, especially over the next couple of years, these are going to become more mainstreamly accepted and standardized. And what I mean by that, right now, they're currently called non-QM loans, which stands for non-qualified mortgage. It's a different way to qualify for a loan versus the traditional way of looking at your ability to repay via your personal income going forward. Remember, DSCR loans are looking at the cash flow of the property itself, not your personal income when we qualify for these loans. But I think as the investor demand grows over time, that this could potentially be more mainstream going forward than what it typically is right now. I think that potentially, the big aggregators like Fannie Mae and Freddie Mac may eventually adopt these DSCR type loans and products and making them more accessible and affordable down the road. So if it's more accessible down the road and more affordable down the road, what that could mean is lower interest rates on these types of loans. So I think that's definitely part of the future, that as these things become more and more popular and more mainstream, that they're going to be more accepted and maybe even more standardized going forward with different types of loans. Okay. Number two, I think that these could potentially expand to larger asset classes. So right now, the focus on residential DSCR loans is definitely 1 to 4 unit properties. So anything from single family residences, condos, townhomes, PUDs, like I said, single family residences, and even 2 to 4 unit properties are all part of the residential DSCR loans right now. In some instances, you can still do DSCR loans on 5 to 10 unit investment properties, so small apartments. The lender pool that allows for those types of loans is much smaller than it is for those residential 1 to 4 unit property DSCR loans. So I think that as time goes on, you're going to start to see an expansion. More and more lenders are going to do 5 to 10 units, and potentially going forward, this could even get into like maybe 10 to 15 units, maybe even 10 to 20 units, depending on how often these things are going to, how much an appetite an investor has for these types of loans as they see that they continue to perform as investments for, secondary lenders in the market. So definitely, I think that there's a potential that these could expand into larger asset classes going forward. Number three, I think that these will have a better integration with short-term rental models. And what I mean by that right now is that with Airbnb and VRBO, that they're totally booming, lenders may create like more specialized products for these specific types of properties, in particular short-term rentals. Now, plenty of DSCR lenders right now are able to do DSCR loans on short-term rentals. The guidelines vary. I've seen some very, very good ones that, what they'll use is actually what's called AirDNA to predict what the rental income is. So as data gets better and things get better, I think that you'll see that, these will expand to more lenders for short-term rentals going forward. So definitely a more of an integration with short-term rental beyond what they already have right now. Now, don't get me wrong, you can still qualify just fine for a short-term rental. The pool of lenders that do these is a lot smaller than there are for the long-term rental properties, but there's still plenty of them available. But I think as time goes on, you're going to see more and more lenders are going to want that short-term rental model. And also, it's going to probably depend on what the market does as well. Like, some markets are great short-term rental markets, but as they become more and more saturated with, more and more people in more and more short-term rentals in certain markets, like, you got to think that at some point, like, those are going to be too saturated for short-term rentals. So hopefully those short-term rentals will expand into different areas that are not typically known for short-term rentals right now going forward. Number four, I think that technology-driven underwriting is going to get more and more get better and better. So I think that you can expect AI-driven property income analysis models. So remember, I told you have to go oftentimes to outside sources. You have to go to like Zillow. You have to go to rentometer.com to figure out what the rental income is. So those are outside sources. I think that as these become more and more popular, that you're going to start to see artificial intelligence do some of the income analysis, which is a major part of doing DSCR loans, and figuring out rental comps as well. I think that AI is definitely going to help us out in determining what those types of loans look like going forward. So technology is a big piece. This could even speed up like approvals as well. So instead of having an actual person or an underwriter go through this, imagine if it was just a computer generated decision based off of historical data and doing these loans over and over and over again going forward. So what that means is that these could close potentially faster than they typically do right now, which is probably about 25 or 30 days, which is still pretty fast in most markets. But what if we could close one of these in 15 days or 21 days? And it's definitely possible right now, but there's a lot of human element and human error that could potentially, throw that off going forward at the current time. But going forward, if we have, AI help us out with that stuff, it might be even faster to be able to close these loans. Number 5, I think there'll be greater flexibility with the prepayment penalties. Right now that they exist because lenders don't want you to pay off these loans too fast without taking on some extra risk in terms of interest rate. So what that means is if you have a shorter prepayment penalty or no prepayment penalty, the interest rate is going to be higher. So you're taking on more risk with a higher monthly payment than these. I think that, as these become more and more popular, as the competition amongst lenders increases, meaning more and more people are going to do DSCR loans, I think that you're going to start to see, pressure to lower the prepayment penalty costs of these types of loans. So typically what we see, a prepayment penalty is a fixed prepayment penalty of usually like 5% of the actual loan balance that's refinanced or paid off early. Some of them are starting to show declining prepayment penalties, meaning that they start at X% and then they get 1% less every year. So if you did like a 3-year prepayment penalty, be a 3% penalty in the first year, 2% penalty in the second year, 1% in the third year. I think that as competition amongst lenders and more lenders are doing this, I think you're going to start to see those prepayment penalties start to erode a little bit and go down. So that'd be a good thing for us as investors for sure. And lastly, I think that as these things become more mainstream, kind of like we talked about, number 1, securitization and investor appetites will definitely increase. So securitization means like with conventional loans, what they do is they package a whole bunch of loans together and they sell that on a secondary market where investors buy pools of mortgages because they're typically a safe investment. Ask the people in 2008 if that was a safe investment or not. But there was a lot of data that was probably misguided and a bunch of crap thrown in there at the same time on those types of things. But as the securitization might happen for these packages and pools of DSCR loans going forward sold to end investors, I think that's going to be great for the industry, because when that happens, you're going to start to see lower interest rates on these types of loans compared to other types of loans as well when they become securitized. So I think that's also part of the future of DSCR loans. Okay, so 6 great points here that we made: mainstream acceptance and standardization, expansion into larger asset classes, integration with short-term rental models, technology-driven underwriting, greater flexibility in prepayment penalties, and securitization, I think are the 6 great benefits for the future of DSCR loans and what they may entail. If you would like to talk to me about this, I'd be happy to chat with you about DSCR loans and how I can help you. I'm going to put my calendar link down below. Go ahead and click on the calendar link. And if you get a chance, please schedule a call with me. I'd love to chat with you more about how I can help you with your DSCR loan. All right, thanks a lot. And I look forward to working with you on the next show. Have a good day.